then the Commerce Department will be able to direct mining, recycling, and other efforts around critical minerals. That's an area where the U.S. government sees an enormous strategic importance in having that industry active domestically and not be dependent on foreign sources, Mike. So we'll get you any confirmation of that as soon as we can. In having that industry.
All right, Eamon, thank you. Retailer earnings season, meanwhile, in full swing. Walmart, the latest to report results, posting its first quarterly miss since 2022. The retailer also sounding an alarm on rising tariff costs. You see the shares down almost 5% on the day. Ross Stores set to report today after the bell. That stock in the red as we head into the close as well. Joining me now is TD Cowen's senior retail analyst, John Kernan. John, it's good to have you here. What's the setup, into Ross and the remainder of retail season? We've obviously heard from Walmart, also, of course, heard from TJX a few days ago or a couple days ago. So how do things look from here?
Yeah, sure. Broadly, retailers and consumers are showing decent strength as we head into the fall. We're almost through Q2 earnings season. We've had some good positive surprises to the upside, but also some nasty downside surprises. The environment from both the top-down and bottom standpoint is extremely bifurcated at this point.
And what are the implications of that bifurcation, let's say on Ross, just to keep it immediate?
Sure. Ross Stores is a cousin of TJX. TJX yesterday beat and raised, stock at an all-time high. It went to its all-time peak valuation multiples. Ross serves lower income consumers. It has a similar financial algorithm to TJX. There's a huge valuation discount between Ross Stores and TJX right now. It's about 25% on a PE basis. We think that can narrow. We like the initiatives the new CEO, Jim Conroy, has in place. And we think they'll report some upside to Q2 same-store sales and EPS. And we think they will initiate full-year guidance tonight after the close. That'll be fairly in line with consensus expectations.
And what, in your view, has accounted for that wide valuation discount opening up between TJX and Ross? Is it geography? Is it the customer segment that Ross is more exposed to?
It's both. There's fear built into the valuation of Ross. We think it's related to 50% of their stores being in border-like states, California, Texas, Arizona, Florida. They have a very heavy Hispanic exposure and lower income exposure. They're dealing with lower income consumers than TJX. They have different brands in the store. They service consumers with different price points. But we do think comps can accelerate to 3% in the coming fall quarter. And we think you'll see better gross margin trends. So that can close the gap, we think, versus the current valuation gap versus TJX.
And then more broadly speaking, I know you were taking a look at how back to school is pacing and some of the trends and maybe chains positioned to benefit from a little bit of an apparel cycle in particular.
Yeah, two of our top picks, Ralph Lauren, Amer Sports, have had tremendous innovation. The brand management from the management teams has been tremendous. We continue to see positive estimate revisions based on better than expected sales and gross margin. These companies are well positioned to deal with tariffs, and a lot of companies are not well positioned to deal with tariffs. My 20 stock coverage list, they owe the U.S. government collectively about $3 billion in profits. So, like I said earlier, it's going to be a bifurcated environment. Those with pricing power, those with innovation are going to win.
And those companies you mentioned being better positioned on tariffs, is that, I guess, a lasting advantage in the sense that they can continue if these tariffs remain on? Or has it been a front-loading and inventory management effect so far?
Yeah, they've managed inventory very well. They have pricing power. They also are internationally diversified. So in the case of Amer Sports and Ralph Lauren, less than 40% of their EBIT is coming from North America and the United States. So that's a help. And they also have brands with pricing power. And if you can raise price and realize that raised price increase, mid-single digits to high single digits, you can offset the tariffs and even see some margin expansion. And that's what we've heard from some of these companies, that they're in a position to mitigate tariffs. Now, that on the flip side of that, there are many companies that are not positioned to do that. And that's where you've seen the downside to earnings. And you'll continue to see that into the first half of next year because of inventory, higher cost inventory is going to flow through.
I was going to mention, where it seems like the companies have it tougher. Is it in footwear or is it particular categories?
It's broad-based across multiple categories. It's the companies without pricing power, without innovation, without enough demand that are over-inventoried and are over-reliant on the U.S. market in particular. We've seen some big downside surprises from Under Armour, Columbia Sportswear, and others. And I think you'll continue to see some downside surprises as we get into the back half of the year from others.
All right. Yeah, kind of a choppy environment, but makes it interesting to watch. John, thank you very much.
Thank you.
All right, up next, we'll take you inside Disney's decision to shake up its ESPN streaming service. That's after this break. Closing bell. Be right back.
NBC Plus.
Welcome back. Disney launching ESPN's new flagship streaming app. That doesn't mean the company's ditching its focus on linear TV. Julia Borston is here to explain. Hi, Julia.
Well, this is a landmark moment for Disney as it offers unlimited access to ESPN via streaming for the first time. And Disney is also pushing its bundle with ESPN, Hulu, and Disney Plus, giving those apps to ESPN subscribers at no additional cost if they're already subscribing to ESPN. But rather than ditching its linear business, Disney is using these apps to make the pay TV bundle more appealing, as subscribers to Comcast, Charter, and other pay TV providers will get access to the ESPN app. And Disney won't be reporting subscriber numbers for the ESPN app as it manages the combined TV and streaming business holistically. Take a listen.
A number of other companies are exiting their linear business completely, meaning they're selling off the channels that serve the linear television ecosystem. We're doing the opposite, actually. We're combining them, which gives us the ability
I'm going to tell you that the people who
subscription fees and advertising on both sides, and essentially end up with a business that's actually larger and more impactful than it would be if we were to separate them completely.
Bob Iger is referring to the fact that Comcast is spinning off most of its cable assets, including CNBC, into Versant, which starts trading separately in the new year, while Warner Brothers Discovery is spinning off most of its cable TV assets, including CNN, TNT Sports, and Discovery, into a new company called Discovery Global. That deal is expected to close in the second half of next year. Now, when it comes to competing with the now more fragmented landscape, Iger says he believes that they are positioned, quote, extremely well. He also has said he's open to bundling with other sports apps as they're bundling with Fox One. Back to you.
Yeah, exactly. So just different bundles in different places. And I guess, Julia, a company like Disney, the dream in this environment probably is to maybe almost be agnostic as to how customers consume their content, right? Whether it's the way it's priced on a streaming app only or part of a bundle. I mean, are they at that point? Do we know if they've achieved something like that?
Well, it seems like they're agnostic as to how you pay for ESPN, but they have said, Jimmy Pittar and Bob Iger said, they really want you to consume content on this new ESPN app because they think that's going to be the best experience. And if you have the best experience, if you're engaging more, whether you're making bets or tracking your favorite teams, getting all the data, watching all the content you could possibly want through ESPN, that's ultimately better for them, not just in terms of ad dollars, but also in terms of minimizing churn. So they said, even if you're paying for ESPN through Spectrum or Comcast, they do want you to be able to go to ESPN and watch and do all your sports fandom there.
Sure, yeah, on the run, and obviously a maybe greater propensity for sports fans to pay for things like the app than others. Julia, thank you very much. Up next, we are tracking the biggest movers as we head into the close. Christina standing by with those.
We have restaurant chain facing customer revolts over brand makeovers, solar stocks cratering on Trump's renewable freeze, and grocery delivery wars are heating up. Those stories next.
Insurance.
20 minutes till the closing bell. The S&P 500 down 0.4%. Let's get back to Christina for a look at the key stocks to watch.
Cracker Barrel. Those shares sinking amid growing backlash over the restaurant chain's first logo redesign in 48 years. The company announced Tuesday it would remove the image of a man leaning against a barrel from its logo, sticking to a text-only format. It comes amid a broader revamp for the company where they have remodeled locations to remove some country-themed trinkets that line the walls, and that's why you're seeing shares back down 8%. The solar sector also taking a hit today following a post from President Trump yesterday that the U.S. will not approve any solar or wind power projects. That came after the administration tightened federal permitting for renewables just last month. For solar and array, two of the biggest decliners you can see down 6.5%, 6% also. Enphase, another name lower, you can see almost 4%. So just red across the board. And lastly, though, I have some more red. Instacart sliding on a downgrade to underperform from neutral at Wedbush, the firm citing the expansion of Amazon's grocery delivery service as a major headwind for this stock. They lowered their target to $42 from $55, which is really just an implied 7% downside from yesterday's close. In other words, they expect it to keep falling 2.5% lower. Instacart parent company Maple Bear. Mike?
Yeah, just made a new high a couple of weeks ago, I guess, that one. It's turn of fortunes. Thank you, Christina. After this break, we'll hear from top technician Paul Ciana, the key levels he's watching and how he's positioning as we look toward year end. Closing bell. Be right back.
7.
Energy leading the S&P higher today, with consumer staples lagging due to Walmart earnings. The Nasdaq on track for its worst week since May. You see the S&P now down 0.4% on the day. Here to share key levels to watch is Paul Ciana of B of A. He's B of A's head of FIC and Equity Technical Research. Paul, it's good to see you.
Thank you, Mike. Good to be back. Thanks for having me.
Start kind of with a wide frame here on the S&P 500. I knew you guys had a summer rally target of 6,500. We basically got there
pretty much
at the highs this month. We're chopping around. People talk about seasonal weakness. What do you think the market is undergoing right here?
Sure. When we look at the S&P 500 technicals, right, there's a few concerns. One is some of that seasonal weakness that comes into September, but also some of the oscillator divergences. So the rally into almost 6,500 slowed down according to momentum and trending indicators. So in August, what we had recommended was trying to hedge S&P longs while we're hitting new all-time highs. And we still like that view.
Okay, so at this point, it's a matter of staying in the market, but maybe being attentive to protecting some downside?
Yes.
What would tell you that this phase is more than a routine pullback? Like, where would the S&P have to fall to for you to say, okay, it's a different trend now?
Yeah. S&P 500 in round numbers, we're in a range between 6,200 to 6,500. I think if we're breaking 6,200, which was a key low about 6 weeks ago or so, then we could be in a deeper decline in a worse scenario.
Okay.
But until then, it looks more range-bound, consolidatory than it does look mega bearish.
And then just in terms of the parts of the market that were the most stretched, right, whether it's the NASDAQ 100 or something like that, is there more to give back?
Probably.
Yeah.
I think one way to look at the equity market is, in order for the rally to keep going, we need rotation, we need breadth, and we need some really simple breakouts. It's really disappointing to see that the Dow Jones Industrial Average still is not through 45,000.
Yeah.
You see it up on your board
struggling
there.
under
We're just
there,
sitting
yeah.
right near that. So without the big cap blue chip stocks
Right.
joining the rally, we're not really going to push that much further, broadly speaking.
Yeah, I guess the Dow first touched 45,000 like in December or something. So it's been a while.
Yeah.
Let's talk about the 10-year Treasury yield. Broadly speaking, pretty range-bound, but where do you see it potentially heading from here?
I would say we're tactically bullish treasuries, cyclically bullish treasuries,
Okay.
but secularly bearish.
Okay.
So what we've been telling clients is that we think 10-year yield in the shorter term probably gets down to about 4.05%. We like buying it here at about 4.3. We just don't want to see the high on non-farm payrolls day back on August 1st of 4.4% broken.
Okay.
Right? Because that particular candle is really the control in the chart. We know that was a bullish day and a bullish view, and we're trying to continue with that in the short term.
Right, bullish day for treasuries, obviously.
Yes.
So if we were to go much lower on treasury yield, that's probably not a great signal for the economy. Maybe we shouldn't celebrate that. Or?
It could be.
Yeah.
You know what? There's a lot of different ways to slice this.
Yeah,
Lower
yeah.
yields could support the tech narrative,
Right.
Which may allow something like the Dow to break 45,000
Sure.
finally. So, yeah.
Quickly, platinum. What's it doing in relative to
Chart.
gold? Yeah.
Gold has been stuck in a range for
Sure.
6 months, right? And I think if you ignore some of these mega charts that have ranges on them,
Yeah.
you can find other charts that are going to break out and start trending. And platinum was one of those that we recommended buying platinum back near 1,000.
Okay.
It had some big breakouts, and it's dipping now. And we like to say, buy the dip and get ready for the
I was
rip.
going to say, still up 35% from there.
Yeah.
Paul, great to see you. Thank you.
Thank you.
Appreciate it. All right, we are getting a news alert. Julia Borston has that for us. Julia.
Hey, Mike. The Wall Street Journal reporting that NBC Universal and the MLB are nearing a 3-year deal that would be worth nearly $600 million. And also that Netflix is in advanced talks with the league to stream the Home Run Derby, and a deal that would be worth more than $105 million over a period of years. Now, we've reached out to Netflix and NBC Universal. No comment from either, but a source close to the situation tells me that while the deal is not as done as this Wall Street Journal article indicates, that the talks are advancing and they are very close and directionally close. I also want to point out that my colleague Alex Sherman has been reporting that this type of deal has been in the works. It seems like we should be expecting some official news soon as we hear that those deals are moving directionally closer. Back over to you.
All right. Yeah, new bidders for baseball. All right, Julia, thank you very much. Up next, Requisite Capital's Brent Talkington standing by to break down the critical final moments of the trading day. The Market Zone is next. We are now in the closing bell market zone. CNBC contributor and Requisite Capital's Bryn Talkington is here to break down these crucial moments of the trading day. Plus, Christina Partsinevelos on a new piece of reporting that has investors on edge. Bryn, good to see you. Just your take on what we've been witnessing in the markets this week. Obviously, some of the overheated parts of the market cooling off. You have some rotation into some of the laggards, maybe a little bit of hesitation ahead of Jackson Hole and NVIDIA earnings. So how are you reading it and how are you playing it?
Well, I think it was a healthy hole in the balloon on some of the growthier growth stocks like the Palantirs, et cetera. That's healthy to have that somewhat of a pullback. I think the rotation, I have a big question mark. What are you rotating in? I think if you're going into small caps, that will continue to be the widowmaker trade. I just think there's too many cross currents for that to be anything more than we'll say a 3 or 4 day trade. And so I think that we're going to have this settling out. Obviously, tomorrow is a really big day with Chairman Powell speaking. And then next week, we've got NVIDIA earnings where they saved the best for last.
Right. So that would suggest that you're not necessarily taking what the market's been doing as a cue to kind of race toward what has not been working. Is that correct? In other words, you wait for the leaders to come in as opposed to, go kind of dumpster diving?
I think so. I mean, obviously, healthcare is really cheap, but there's a big asterisk by that in terms of if you break down within pharmaceuticals, what's going to happen with the White House in terms of the rulings and the tariffs on pharma. We still don't have that. So I think that needs to clear. I think energy is really cheap, but I think Trump administration wants it to stay cheap. So I think it'll stay cheap for a while. And so I just think you have to look at like individual companies. I recently added to Salesforce. So that's where it's been an unloved software sector. I think it's just thrown in with the Adobes, et cetera. So I think there's some individual names, but I still say stay at the high end, the Qs, the S&P. We love selling calls right now. So that continues to be, I think an all-weather strategy for us. That's not only only, timeless, but I think very timely right now to have a good covered call strategy.
Got you. Bryn, stay with me. Christina, what do we have here on NVIDIA?
Well, we have Chinese municipalities that are accelerating efforts to cut NVIDIA from the AI supply chain, with Shanghai targeting 70% self-sufficiency by 2027 and Beijing pushing for 100%, this according to a Nikkei report today. The drive really intensified after Commerce Secretary Howard Lutnick's July CNBC interview with Brian Sullivan, where he called H20 chips for China NVIDIA's fourth best. The FT reporting today that senior Beijing officials were, quote, insulted by those comments and prompted Chinese officials to continue their crackdown on H20 purchases. And so that's why the stakes remain high, Mike. China represents, roughly 10%. Some are saying it's even lower now of total revenues as of last quarter. It's been dropping quickly, but still contributes substantial dollars to NVIDIA's bottom line. While most analysts aren't expecting major China contributions to this quarter, given the April H20 ban, CEO Jensen Huang must convince Wall Street that near-term Blackwell demand and the recent Trump deal, which allows H20 sales in exchange for a 15% revenue cut, would outweigh longer-term risks of being phased out of the world's second largest AI market.
Yeah, it seems a bit of a tricky balance, Christina. Thank you very much. And Bryn, how does this play into the overall thesis with NVIDIA? We've been through different versions of the story with NVIDIA, of course. One, it was massive supply constraints. They can't make it fast enough. Now it's each generation getting better, the sustainability of the AI theme. Where does China fit into all that?
So I think it's important when we talk about what the White House is doing. It's not 15% of just sales, of like NVIDIA sales, it's of China sales. And so I think that's a win for NVIDIA and I guess AMD as well, because they were going to be totally banned, right? They already wrote off the H20 last quarter. So I think for NVIDIA, having 85% of the revenues from China is way better than the alternative of a complete ban. I think you have to take a step back. I mean, this is a $4.3 trillion market cap that come next week is going to deliver plus 50% revenue growth, plus I think it's 43% earnings growth. It's really just rarefied air. And so, I mean, I don't see any company ever in history having this type of consistent, very high double-digit revenue and earnings growth. So, I mean, I just think NVIDIA continues to be, once again, in pole position versus all of their peers.
No, it's fair to say that no company at that scale of revenue has ever grown quite that fast. I mean, this year we're talking about, 130 billion or thereabouts in revenue. I guess the question, of course, is how many years we can extrapolate out growth like that. And I did want to kind of circle back to Palantir, which you mentioned. And again, it seems like kind of the center of this market debate of certain parts of the market ran pretty far, pretty fast. They may not have the fundamental and valuation support that you might like, but Palantir pulls back like 17% off the high. It's trying to stabilize today. How should we think about it?
The last time it hit its 50-day moving average, which is where it is right now, was April. So in hindsight, that was an amazing time to buy back in. But what's the big difference, Mike, is like the rest of the market had sold off. So I think this will be interesting to watch to see what happens to Palantir, because the market is, the market's at basically an all-time high. And so for Palantir to start moving back higher, I think it's going to rest here for a while. I think that so much good news is priced in. This is a great company. They're at the center of AI. But at a certain point, what's not priced in? And so I wouldn't be buying it here. I mean, I sold most of it around 40 points ago.
Yeah, which is really not that long ago in time. So obviously, it's gone a long way. Bryn, thank you very much. Do want to mention NVIDIA current fiscal year is going to do 200 billion-ish in revenue. 130 was last fiscal year. You see the S&P 500 still down about 0.4%. It's going to be a fifth straight down day, although very mixed and rotational underneath. The Russell 2000 may eke out a gain for the day as Wall Street waits for Jay Powell to speak at Jackson Hole tomorrow, a bit uneasily. That does it for Closing Bell. We'll send it into overtime with Morgan Brennan.
Well, that's the end of regulation. Cummins ringing the closing bell at the New York Stock Exchange. ESPN doing the honors at the NASDAQ. Stocks ending the day in the red, but off the lows. The S&P 500 down for the fifth straight day. It's the longest daily losing streak since January for that index. It's the worst three-day stretch for the NASDAQ, too, since April. Most of the losses in the Dow were caused by the drop in Walmart. Energy and materials were the outperforming sectors today. Staples, discretionary, and utilities lagged. Oil rallying for a second straight day on continued signs of strong demand and uncertainty about Russia-Ukraine peace talks. And in a reversal from yesterday's big gains, Bitcoin and Ether falling today. Ether now off by more than 7% over the past week. Treasuries weaker across the curve with yields up ahead of Powell at Jackson Hole tomorrow. This following some hawkish Fed speak from the Cleveland and Kansas City Fed chiefs earlier today. That is the scorecard on Wall Street. Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Fort is off today. The Jackson 5. It's a make-or-break moment for the markets tomorrow as Fed Chair Powell gets set to deliver his Jackson Hole speech. Will he steer away from teeing up a September cut, or will he use the opportunity to ensure investors that the Fed and the market are on the same page? Plus, Powell may be the event of the week, but NVIDIA will dominate next week. It has earnings on deck. The stock has had 5 price target hikes in 8 days. Why is the street so bullish ahead of results? We're going to ask one of those analysts next. And a new $3 billion drug manufacturing plant is getting ready to open in North Carolina, perhaps at the perfect time as the president announces pharmaceutical tariffs. We're live at the plant with an inside look. But first, let's turn back to the markets as the heavy rotation out from the momentum trade continues. Christina Partsinevelos is here with more. She's in studio. Christina.
Yeah, once a week I come here. Retail traders, though, are doing something they haven't done since June, selling tech stocks. That's why we continue to see the information technology sector fall down 3% this week. Data compiled by JP Morgan strategists showed mom and pop investors were net sellers, they're calling it that, of tech to the tune of $140 million just over the past week. That breaks a 2-month-long daily buying streak in which retail traders on average bought more than $1 billion per day. It's also why we continue to see so many of the popular AI darlings like AMD, Supermicro, onsemi, for example, maybe not necessarily an AI darling, but still negative for their 6th straight session. Palantir, though, we're going to throw that up on the screen, is just higher today after 6 straight losses, losing more than 16% over that period. Palantir was also one of the most traded stocks among retail investors just in the past 2 days. You can really see a lot of volume in this name. Check out CNBC or CNBC Pro for more actually on that trend. But I want to point out, they aren't getting out of the markets altogether. The buy the dip mentality is still in play, but the focus is really on broad-based market ETFs like the VanEck Oil Services ETF. That's up 1.3% for the week. And the iShares Healthcare Providers ETF also up 1.3%. And it's helping those respective sectors, Morgan.
All right. Christina Partsinevelos, thank you.
Thanks.
As we mentioned, some movement in the bond market today following some mixed economic data and some Fed speak that was tilting slightly hawkish. Rick Santelli is live at the CME with more. Hi, Rick.
Hi, Morgan. Indeed, today was the 1-2 punch in the Treasury markets. Let's look at a 2-year. Now, as you look at it, realize at 8:30 Eastern, we saw 11,000 pop up in claims. Now, it's still well under 250,000, but up 11,000 with Jackson Hole starting tomorrow made the market a bit nervous. So what happened? Well, we saw that yields at 7:30 made their lows at the 2-year. Why? Claims moving up. Well, that most likely means that we are not going to see as much easing, and that makes sense. But look what happened at 9:45 when you had a strong set of PMIs. Boom! Yields moved higher. Now, maybe the most interesting story, considering Jackson Hole is in earnest starting tomorrow with the big Fed speak and Jay Powell. Well, let's look at a week-to-date of Fed fund futures for Ds. You see the way they moved down today? When they move down, that means there is less easing. And the time they moved down was the strong PMIs. Now, if you open it up to August 1st, you can clearly see the entire month has drifted a bit lower, putting in a little less easing. But here's the key. If you just took in 2 more days in front of August 1st and you look at the jobs report, well, yields or the Fed funds rallied up. When you rally up, you are definitely putting in more easing. So that last chart really says it all. Okay, we haven't gotten back all the run-up we had on the weak jobs report, but the trend and the way we're looking at higher interest rates today, there's a bit nervousness that hawkishness is going to remain stable despite some of the dissenting on the board. Morgan, back to you.
Rick Santelli, the dollar, what has it been signaling? We had one strategist on the exchange earlier today, and one of the things he pointed out is that you've seen the dollar weaken every time President Trump has sort of called into question the policy of the Fed.
Well, what does the president and the administration want? They want lower interest rates. The dollar's never falling in love with lower interest rates. As a matter of fact, even though the dollar is up today, if you look at the dollar since the jobs report, you'll see a lot of info there as well, because it dropped rather dramatically when you had a weak jobs report, because that also implies more easing. So yes, the dollar at the moment, its last big close was right at 100 and it failed. So I would have to say the dollar index would not be on my buy list.
Okay, Rick Santelli, thank you. Well, speaking of the Fed, our Steve Leisman sitting down with Kansas City Fed President Jeff Schmid this morning ahead of the annual symposium in Jackson Hole, Wyoming. Schmid, a FOMC voting member, expressing doubt about a rate cut next month, one the market had previously assumed was all but certain. So here's what he said to Steve on Squawk Box.
I think we've got a lot of data to harvest between now and September, and I think something will emerge where I think we'll start to see a little bit more definitive move one way or the other. Markets seem to be in good shape, spreads. So I think we're in a really good spot, and I think we really have to have very definitive data to be moving that policy rate right now. But yeah, I think there's a lot to be said between now and September.
So will Powell give the market what it wants, or will he try to take the focus off of rate cuts? Our next guest thinks the latter in her new piece titled The Jackson 5. Joining me now is Sarah House, Wells Fargo senior economist. Sarah, it's great to have you on. Welcome.
Thanks, Morgan, for having me.
So what do you think? We have a lot more data here and it's not decided?
We do. So we have, of course, another month of inflation data and, of course, another jobs report. And so I think when we hear Powell tomorrow, I think he's going to be reluctant to pre-commit to any sort of move for September. I think he's going to keep that door open, understanding that the data could tilt in that direction. But I think he really wants to keep the committee's options open, in part because there is not a clear consensus among committee members. And so he can't speak for the committee in that regard.
So as you comb through the data, do you think a shift towards more focus on the labor market is warranted, given the fact that we've seen some softening there, or no, too soon to tell?
I think we are moving that way. So we've been concerned about the overall strength of the jobs market, where it still remains in balance if you're looking at things like the unemployment rate, the openings ratio per unemployed worker. But I think the loss of momentum in hiring, and especially that I don't think this is all just from merely slower growth in the labor supply coming from immigration. So if you look at the breadth of hiring, that's been extremely narrow, and we can't rely completely on healthcare hiring to buoy all employment. So I think we are a little bit more nervous about the overall strength of the jobs market, and that leads us to expect that our base case is still that we will get a September rate cut followed by 2 more 25 basis point cuts before the year is out. But it really hinges on that labor market continuing to show further loss of momentum.
Okay. You talk about the Jackson 5 in your note. What does that mean?
Right. So we are 5 years on from the Fed's last policy framework review. We know they're getting close to announcing the results of their latest review. So we saw that hinted at in the minutes. And so we're actually thinking that Powell's going to use his stage tomorrow to talk about these changes to the policy framework. So this is pretty much going to, we're pretty certain this is going to be his last as Fed chair. So using the stage to walk through his 8-year tenure, talk about how the macro environment has changed dramatically from where the Fed was concerned about the zero lower bound, persistently low inflation, to really the opposite. And so we think he's going to walk through why we need to have a more robust framework, focusing more on symmetry in terms of misses from both the inflation and labor market sides of its mandate, given just the wild ride we've been on over the past 5 years, where we're now in an environment where we're still worried about too high inflation.
Interesting. So would you say that marks a bit of a reversal then?
I think so. So in many ways, this quote new framework will look very much like the old framework, so the one prior to 2020, where the Fed was taking a more symmetric approach to its inflation target. So remember, we moved to flexible average inflation targeting with the 2020 framework, where the Fed was saying we're okay with overshoots if it's come after periods of undershoots, but not vice versa. Well, now we think they're going to move back to, look, we're aiming for 2%, as close to that as possible at any given point. we will let bygones be bygones. And then also just in terms of the jobs market. So with the reminder that you can have an overheated jobs market contribute to too high inflation, we think the Fed's going to move away from focusing on shortfalls for maximum employment and move back to that focus on deviations in either direction.
Okay. Should we be paying more attention to the Fed's balance sheet, especially given what we've been seeing in the bond market with Treasury yields and Treasury issuance?
Yeah, so I think the Fed is still looking to de-emphasize that as a tool. I think at some point the framework will need to address how the Fed uses that as a tool, where really it's been in many ways kind of a last-minute adjustment as we saw in 2020. But I don't think that we'll hear much on that front tomorrow, as I think the Fed is really just kind of trying to keep that quiet. They're, of course, still letting assets mature and roll off, and so still looking to normalize that a bit further and not making that a focal point right now.
We've been talking about Powell as almost like the peak of the next couple of days in this symposium out in Jackson Hole, but we are hearing from a number of Fed speakers, including, we just mentioned Schmidt earlier, who is a voting member, a number of others to the next couple of days, and even some international central bank heads as well, like Christine Lagarde. How closely are you going to be monitoring all of those, since it really isn't just the Fed that investors are focused on with a potential rate cutting cycle, but also other central banks that have either made cuts of their own or poised to do so?
Right, so that's the beauty of the Jackson Hole Symposium. It's this gathering. It's a powerhouse in terms of central bankers and researchers. So while Powell will be the limelight, he'll get that central spot. But it really is more that you're going to hear from lots of different central bankers, and also a lot of good research. So the focus this year is the labor market, and so figuring out how that's changing, and I think also inform how the Fed should be reading a lot of these labor market indicators, given the transition that the jobs market and our demographic population is going through right now.
Okay. Sarah House, Wells Fargo senior economist, thanks for joining me.
Thanks.
Well, coming up, the street is staying, quote, extremely bullish into NVIDIA's print next week, but the stock has started to see a reversal recently, and the company continues to get caught in the crosshairs between the administration and China. Are the expectations too high? And Mike Santoli joins to chart big tech's fear of heights. Why this chart could be telling the most important story in the market. That's next. Overtime is back in 2. Welcome back. Walmart falling today despite a revenue beat and raising its full-year earnings and sales guidance. The retailer warns of tariff headwinds on the horizon. CFO John David Rainey telling CNBC that the company is working hard to keep prices low, including by speeding up overseas imports, but that, quote, tariff-impacted costs are continuing to drift upwards. Now, on the bright side, Rainey said Walmart hasn't seen a change in consumer spending, and the retailer has seen its advertising business boom. It's grown 46% globally year over year. Well, another stock that was lower today is NVIDIA. That's despite a recent slew of price target increases from the street. Morgan Stanley, Cantor Fitzgerald, KeyBank, Susquehanna, UBS. That's all in the last week. And today, Wedbush joins in on the fun, going to $210 per share from $175 ahead of next week's earnings. Part of the reason, an expected rebound in revenue from the Chinese market. So joining me now is the analyst behind that call, Matt Bryson, Wedbush equity research analyst. Matt, it's great to have you back on the show. And let's start right there. Why the hike to the price target?
Yeah, I mean, I think there's a couple of reasons. You mentioned one of them. Certainly, there should be some revenue from China, and we can debate whether it's $1 billion or $8 billion. I think I've been relatively conservative there, but the other pieces are, look, my checks throughout the quarter have been positive, hearing good things about Blackwell Ultra. You look at the CSPs, they're lifting spend. They've been the single largest market for NVIDIA. So you've had a bunch of good news. NVIDIA tends to leave a little bit on the table when they give guidance. And so I just don't see any reason that we don't get another beat. And then another strong guide for fiscal Q3.
So the fact that the stock has sold off in these last couple of days, is that a buying opportunity ahead of the print then?
I think that everything looks good for NVIDIA. It's always hard to tell exactly how it will trade around the print, but I think the concerns kind of this week have more to do with macro. Maybe a bit about the future of AI, given that MIT paper that said something like only 5% of enterprises are really getting value from generative AI. But I think that there is plenty of spend ahead, not only CSPs, but sovereigns. And so I think NVIDIA is looking good through 2026 at least.
Okay, so in light of that, what do you think of that MIT paper? And then I know there was also there was the Sam Altman AI bubble commentary, which was arguably taken a little bit out of context as well. What do you make of all of that and what it means for the future of spending on AI?
Yeah, so I think part of it is simply figuring out how to use the tech. And to some extent, it's a positive that 5% of enterprises are getting real value out of this, right? That suggests that it's not useful to the other 95% of enterprises, but rather that they just need to figure out how to use generative AI. I think that there's a ton of consumer devices coming out in 26, 27 that are aimed at trying to enable AI for the consumer. So again, something else that will use data center resources. And the tough thing is to figure out exactly when you see that viral application, if you will. But having said that, because we have all this sovereign spend that gets layered on top of the CSP spend, I think there's 18 months for that event to happen before we have to worry that, maybe spend on data center falls short of expectations.
I want to go back to the China piece for NVIDIA specifically, because if I'm recalling correctly, in the last couple of quarters, they basically de-risked the China business, and a lot of that was pulled out of the forecast and the guidance. So do you expect that to be layered back in now, given what we're seeing with these H20 chips, even if there is a 15% cut of sales going back to the U.S. government?
Yeah, so I think there's going to be some revenue from China. I think the real question is, look, NVIDIA was set to do $8 billion in Q2, or at least that's what management thought they were going to do. What's the real level right now? You've got headwinds from that 15%, the export tariff, if you will. You have the Chinese government pushing its companies not to use the H20, but NVIDIA is still going to see some revenue from China. And the real question is it $2 billion? Is it $4 billion? I've been relatively conservative in layering it in. So I only have $1 billion, $2 billion over the next couple quarters, a little more than that next year when you start to get the Blackwell parts out. But I think it's still a benefit versus where we'd been a quarter ago when it looked like China was going to be zero.
Okay, Matt Bryson, thank you. Well, still ahead, is big tech about to see a real downturn? Mike Santoli has a theory. He's betting that one key chart is telling the markets the most important story right now. And after what's been a brutal year for the stock, United Health has seen a reversal of fortune lately. It's up 22% this month. We're going to speak to one money manager who says now is the time to buy because the bounce is more than just about Buffett's stake. Stay with us. Welcome back. Take a look at Cracker Barrel. The stock tumbling 7% today after debuting a new text-only logo as part of a larger brand refresh. The company is about a year into a 3-year, $700 million plan to modernize the business and lure in new diners. The chain has also been remodeling its 660-plus restaurants. The new logo, as you can see right there on your screen, it's attracted some blowback with many social media users, especially in conservative circles. CEO Julie Masino saying this morning, though, that feedback to the changes have been, quote, overwhelmingly positive. Well, now let's bring in senior markets commentator Mike Santoli for a look at how stretched the tech sector is, with the NASDAQ now pacing for its worst week since May. Mike.
Yeah, we had a pretty good head of steam in tech, as you know, Morgan, over the last few months. Here's the tech sector ETF of the S&P 500 over the last 3 years with its 50-day moving average. You see this pullback? It's just a little over 4% from the high. Not really a major pullback at this point, and we're just above that 50-day moving average. Now, when we've had these periods when it's been above that trend line for a long period of time or has been well above the trend line, it hasn't always just backed off and bounced off the level. You see sometimes it's got to chop around in there for a bit around that 50-day average if, in fact, it's going to rebuild and refresh for a new run higher. So that's just something to keep in mind. What would qualify as a routine setback is still probably a little bit down from where we are right now. Now, just here to quantify exactly how strong the 4-month run was off of the August lows. into April lows into August. Pretty much one of the best ever. So this is the 4-month rolling returns of the tech sector of the S&P 500. It got above 50%. It's only done that a few times, as you can see, including once during the pandemic rebound. This, of course, is the ultimate peak back in late 90s into the year 2000. We're not close to that. It's above 70%. But again, it suggests that there's some kind of a logical reset you might expect this to have, even if it's just going sideways, to bring this number down for a little while, Morgan.
Now, I realize the S&P tech sector is probably more skewed to things like Apple and semiconductors specifically.
Yeah.
But if we're looking at, say, the Mag 7, I mean, Goldman Sachs earlier this week, David Kostin over there, basically saying that the other magnificents grew their earnings, ex Nvidia, which we get next week, grew their earnings per share by 26% year on year in the second quarter, which was well ahead of expectations. So, yes, I realize we're long in the tooth, maybe overbought here, and you're starting to see some of that selling. But is the earnings piece of the picture one that's still so strong that the expectation is they're still going to power the S&P higher?
Yeah, it's absolutely holding up its side of the bargain. The fundamental side, the earnings trajectory, it's all working out fine. It's just a matter of exactly what the market's willing to pay for that in real time, right? Up 50% in 4 months. Well, guess what? Earnings didn't go up 50% in 4 months. So it's probably sort of a catch-up for the fundamentals to the stock prices.
Got it. All right, Mike Santoli, we'll see you later this hour. Thank you. It's time now for a CNBC News Update with Christina Partsinevelos. Hi, Christina.
Hi, Morgan. The State Department will continue to vet visa holders even after they've been admitted to enter the United States. The department said today that more than 55 million foreigners who hold visas would continue to be vetted for any potential ineligibility, such as overstays and threatening public safety. A federal judge ruled this afternoon that acting U.S. Attorney for New Jersey, Alina Habba, can't prosecute 2 defendants who sued, challenging her authority because she was not legally appointed to the role. President Trump tried to use a loophole to keep her in place after her interim status expired on July 1st. The judge stayed the ruling to allow the government time to appeal. And the California State Senate this afternoon passed a redistricting plan to advance Governor Gavin Newsom's attempt to counteract Texas's vote to add 5 GOP-leaning seats. Unlike Texas, California's effort needs to be approved by voters because the state constitution requires that an independent, nonpartisan panel draw the congressional map. The bill faces a Friday deadline to get in on the ballot for a special election this coming November. Morgan?
All right, Christina Partsinevelos, thank you.
Thanks.
Next up, we're diving into the markets with one of Forbes' top women financial advisors, Brooke May of Evans May Wealth, on why she thinks a year-end rally is in store. That's next. Plus, a surprise name is getting in on pharmaceutical manufacturing as tariff threats loom. We're live from the factory right after this. Overtime is back in 2.
With Betterment.
Welcome back to Overtime. Stocks ending the day in the red as the sell-off continues. The S&P posting its fifth straight losing day. Some action in the after hours, though. Let's start with Intuit, falling right now. The company beating on EPS and revenue, but its consumer segment missed estimates. You see those shares are down about 5% right now. The company emphasized its recent focus on AI as a growth driver, with the CEO saying that AI has helped them to grow in its Credit Karma business. But Workday slightly lower in after hours as well. The company reporting a beat on both EPS and revenue, with second quarter subscriptions meeting expectations. Workday saying it will acquire AI company Paradox. Those shares are down about 5%. And finally, Ross Stores. The retailer reporting an EPS beat, but a revenue miss, included in the revenue number was an 11-cent per share negative impact from tariff-related costs. Now, Ross saying that they anticipate pricing across retail will move higher as they progress through the year, and yet those shares are popping. They're up 2% right now. So the rotation trade continues, with investors pouring into some of the underperformers this year. Take United Health. It's down 40% this year still, but now one of the top winners in the Dow so far for this month. It's up 22% for August. Our next guest sees opportunity in the stock and says investors should buy. Joining us now is Brooke May, partner at Evans May Wealth. She is also on on Forbes' top women advisors list. And Brooke, it's great to have you back on the show. Welcome.
Thank you, Morgan.
As a former Forbes alum here, a little slip of the tongue there. All right, let's start with United Health. Why do you think this is a buy right now?
If you look to your point, it's down 40% year to date and down 50% from the all-time high. Last week, though, we heard that Warren Buffett took a 5 million share stake, which equates to about 1.6 billion. So we think that this is a good buying opportunity. The stock's trading at about 18 times forward earnings. And historically, it's been very well managed. So we think if you're patient, it's an area that you could make money in the months to come.
It's interesting, too, because it isn't just United Health. Healthcare as a sector is the top performing one in the S&P this month. And it sort of speaks to this big rotation we've been talking about.
Healthcare has been beaten up. It hasn't been a good investment until just recently. And healthcare is resilient. It won't stay down forever. And so we do think that if you're selective, there are some good buying opportunities right now.
Okay. What do you think of tech?
We like tech. We think we're in a mega trend when it comes to tech. However, in the near term, we think it's overbought. So we follow the earnings. We think tech is where the earnings growth is going to be. We think it'll lead us into 2026 with strong earnings growth. We think earnings could be up 12% next year. However, in the near term, it's overbought. So we're looking at other areas of the market and being a little more selective.
We know we're in a very seasonally weak time of the year where you tend to see volatility. To your point, some of the high-flying parts of the market continue to look a little bit overbought, and you're seeing some profit taking right now. If we continue to see a pullback here, is it a buying opportunity, or you just sit on your hands?
I would be patient. September, October tend to be volatile months in the market, and I don't know that this year will be any different. We've had a parabolic move since April. And when you look, the question is, what's the catalyst going to be for a pullback? We've seen weakening labor data in addition to higher inflation than expected. And right now, the market's pricing in about a 73% probability that we'll see a rate cut in September. And if it doesn't come to fruition, you can expect volatility to kick up.
You think we get a cut from the Fed next month, and how much does that matter?
I think if you look back the last few years, the market's been overly optimistic on the number of rate cuts that we would get, and they haven't materialized. This year might not be any different. We might only see 1 or 2 rate cuts. If we get a rate cut in September, I don't know that we'll get another one before year end if the labor market holds up. Just recently, the majority of Fed governors have indicated that inflation is a bigger risk than the labor market right now. And so if you look at the most recent CPI rating at 3.1%, that's a lot higher than expected. And so I wouldn't be surprised if the labor market holds up if the Fed pauses in September.
Russell 2000 actually finished the day fractionally higher, and while it's on pace for a weekly loss like all the other major averages, it is the outperformer so far this month. Is this on Fed rate cut expectations, or is something else afoot here?
I think there are a lot of factors at play. Small cap has been out of favor for some time now. Those companies rely heavily on debt. And with variable rate debt being at higher rates, it cuts into their profit margins. So they need a rate cut to really stimulate their profit margin and their revenue and earnings, or their earnings growth. It might be a little too soon, though. I would be patient. We're hesitant to move into small cap in a meaningful way right now.
All right, biggest risks to this market?
The labor market. Everything hinges on the consumer right now. And if the consumers have jobs, they're going to spend. And, we're seeing some softening there. All that said, when you listen to CEOs in the most recent survey, 66% are keeping their projection for their workforce at least stable, if not expanding it over the next year. And when you talk to them about what they're looking for to combat higher input costs, they're leveraging technology. They're upskilling their labor force. They're looking at aggressively negotiating with their suppliers, and they're going to pass a little bit of those higher costs on to consumers. So there are 7.4 million job openings right now. However, with the upskill in labor, there isn't always a match between unemployed and the job openings. So we think we're in an environment that's slow to hire, slow to fire. We expect the labor market to stay afloat, but we could see 1 or 0.2 of a point higher in unemployment.
Okay, we'll watch for that. Brooke May, great to have you on. As always, thank you.
Thank you.
Up next, we're inside one of the largest biologic drug manufacturing plants in the U.S. It's 5 years, $3 billion in the making. Angelica Peebles is live in Holly Springs, North Carolina. Angelica.
Hey, Morgan, that's right. We have been here all day getting an exclusive first look at this facility that's just weeks away from opening up here in Holly Springs, North Carolina. We'll be back in just a few to show you exactly what's going on in here.
free when you switch.
Welcome back to Overtime. Solar stocks sinking today, with First Solar, Sunrun, and SolarEdge all in the red as President Trump took aim at renewables this week. He called the industry, quote, the scam of the century, and said that the government will not approve wind or solar projects. Now, despite today's dip, the stocks are all still up double digits over the past 3 months after the Treasury Department had given solar and wind companies the chance to continue receiving tax credits before new limits in the tax bill kick in. Meanwhile, surprising and timely way to thwart tariff threats on the pharmaceutical industry, Fujifilm opening a brand new drug manufacturing plant in North Carolina. But it took 5 years and billions of dollars. And our Angelica Peebles is live at the center of the action to tell us more. Hi, Angelica.
Hey, Morgan. Well, this hallway behind me, it's as long as 3 football fields, and it connects 4 buildings at Fujifilm Biotechnologies' new manufacturing plant. So the first 2 buildings over here, those will open in just a few weeks, and they'll produce biologic drugs for Regeneron and Johnson & Johnson. The second 2 buildings over here, those are scheduled to open in 2028. Now, by the time that this facility, is open, it'll have the capacity to make 50 million doses of medicine a year. And the key to that production is the bioreactors. There will be 16 of them, and they can each fit up to 20,000 liters inside. So you use those to grow the cells that are producing the protein that will eventually power a drug. And a lot of this work has historically been done in Europe. That is starting to change because we are seeing more companies wanting to do that here. And you can see that in the investments in Europe. In the U.S. over the past few years, they're pretty stable, but the U.S. commitments have ramped up significantly over the last year, and they've basically ground to a halt in the EU as President Trump has threatened tariffs on pharmaceutical products. Now, North Carolina has benefited from the boom with a record $10.8 billion of life science investments pledged last year alone, Morgan.
Yeah, this is super fascinating to me because obviously it takes a while and it takes a certain amount of capital to be able to stand up this type of capability on U.S. soil. I think a lot of folks, I just learned this today, the HHS actually has a national security wing. And so when we talk about this increasing intersection between industrial policy, or I'll say manufacturing, and supply chain resilience and national security, pharmaceuticals fall under that as well. We saw that with the pandemic. So I guess it raises the question, how quickly and perhaps just as importantly, will tariffs help to spur more investment here stateside?
Well, that's the great debate, and it is something that the Trump administration has talked about as a national security concern. They are concerned that we make many of our drugs overseas, particularly critical medicines like antibiotics. A lot of that is happening in places around the world and not so much the U.S. Now, biologics are a little bit different. These are really expensive to make, and they carry pretty high price tags. So you are seeing more U.S. companies take on that risk, do that manufacturing here, like what we're seeing at Fujifilm. And so that will change over time as you start to ramp up the capacity. But again, there is a little bit of a divergence between some of those generic drugs and the branded drugs. So we'll have to see how that plays out over time.
Okay, Angelica Peebles with a live shot of the day. Thank you. On deck, Disney shaking up the streaming industry with a brand new bundle. But is it enough to wake up the house of Mouse's sleepy stock? We're going to dive into that and look at the recent wave of media consolidation. Plus, as big tech and the chips dip, defensive sectors are outperforming. Is it a seasonal trade, or is it telling us something about the underlying economy? Mike Santoli is going to dig into that next. Overtime is back in 2.
09.
Welcome back to Overtime. The long-awaited ESPN flagship streaming app launched today, offering its full sports content outside of a traditional TV bundle for the first time. Will the new app give a boost to Disney? Well, CEO Bob Iger is betting on it.
Look where ESPN is today with all of the competition that has emerged over the years. I actually think they're in the best position they've ever been in. And now with the use of this great technology, they have the ability to engage with sports fans at a higher level in a better way. And so, look, we don't in any way want to dismiss competition at all because we're mindful of it. But I think we're positioned extremely well.
Well, joining us now is Tom Rogers. He is the first president of NBC Cable. He's the founder of CNBC, currently an executive chairman at Claire Grid, and now a senior advisor to Versant, soon to be CNBC's parent company. He is a CNBC contributor as well. And Tom, it's always great to speak with you. Welcome.
Great to see you, Morgan.
So let's start right there. Bob Iger is obviously betting on this launch of this ESPN app. How do you see this for Disney?
Well, this was supposed to be a D-Day for the cable industry. If ESPN ever went streaming and was available outside the cable bundle, that was supposed to be the ultimate nightmare. And Disney, being the biggest program channel group within the cable bundle, it was going to be a bad situation everywhere it went. I don't think this is a bad situation for the cable industry per se, meaning I don't think it's going to catalyze a whole new level of cord cutting. And at the same time, I do think this enhances Disney's position. I don't think so much because it's going to get an enormous number of standalone ESPN subscribers. But I do think that ESPN, Disney Plus, and Hulu as a bundle, particularly at the $29.99 introductory price for a year, really has an opportunity to establish itself as a great piece of entertainment for the family, covering sports, children's programming, adult programming, some news in there. And that may be a new catalyst for the company.
Okay. I feel there's so many bundles. It's almost like cable 2.0 with all these mini bundles now.
Well, that is true. And it is a way, particularly if you're willing to live through advertising on your streaming service, to find some pretty interesting ways to get the cost down of packages of programming. Obviously, what started the whole cable cord cutting dilemma was that cable bundle just got too bloated. It got too pricey, and consumers really didn't have a way of getting pricing down. At least in this environment, there are a number of ways to do it, including just disconnecting. When you're finished with football season, you may not want ESPN anymore, and that becomes a much easier thing to do in a streaming environment than it was in the cable bundle.
Are sports streaming rights still the crown jewel of the future of streaming and the future of cable and anything else that can, or anyone else that can get their hands on those rights? I ask as NBC Universal, so our parent company, and MLB are reportedly nearing a 3-year deal approaching $600 million. And apparently there's another deal in the works with Netflix with MLB.
And some reporting there as well that ESPN will be part of that, even though baseball and ESPN walked away from each other a number of months ago. It's an interesting situation because, yes, certain sports are certainly critical to both the broadcast world and the streaming world. I think 85 of the top 100 programs on broadcast and cable TV were sports programming. Netflix has been able to build the leading streaming service with almost no sports at all, although they have begun to get into the sports business. And if they take the home run derby here from baseball, that'll be another piece. But I think baseball may be an example of the price escalation of sports rights beginning to slow down some. It's reported that the three companies they're going to do a deal with will end up with sports rights that exceed what the previous deals ESPN had. But my guess is it won't be the kind of escalation anywhere near that basketball saw in percentage terms, or that football has seen. And the big one that we all have to look at is, now that the Paramount deal is closed, but that change of control has given the NFL an opener to be able to renegotiate that deal. What the pricing on that is may establish yet a whole new level of escalation in major sports.
Oh, I'm glad you brought that up, because I was going to ask you why Paramount Skydance has had such a huge run as of late. It's up 23% in a month. It was closed up 14.5% higher today alone. Is that what's driving it?
Well, that may be a negative, in that they were presumed to have football tied up for a while, and how much more they may have to pay to hold on to it is certainly going to weigh on earnings. On the other hand, I think they demonstrated with the UFC sports deal, which they took 100% of, and nobody expected one party, and especially Paramount, to take the whole UFC package, and they obviously were willing to bid quite aggressively. So I think the view there is that there's a new player in town that is going to play very aggressively to build for the long term, even if short-term results are hurt. And there are a lot of people who might be willing to bet on, if you're willing to play it that way, you're going to end up with something far more valuable than you have today.
Okay. Tom Rogers, thank you. Always great to get your insights.
Great to be here. Thanks, Morgan.
Coming up, the next great rotation. Mike Santoli's back. He's got a closer look at an emerging trend in the market amid the tech sell-off. We'll be right back.
C+.
Welcome back to Overtime. Now let's bring back senior markets commentator Mike Santoli for a look at the recent reawakening of defensive sectors as tech stocks have continued to slip. Hi, Mike.
Yeah, Morgan, well, the question is whether that part of the market continues to stay awake because there have been some false starts. Take a look at this pretty clean view of the cyclical leadership of the market that's built up over the last year. These are all equal weighted sector indexes. So that's consumer discretionary, that's industrials. Looks very, very similar, like the same chart over the past year. Huge advantage, near new highs relative to healthcare and staples, which have obviously been coming back a little bit in the last few weeks and have narrowed that gap a little bit, but not necessarily in such an emphatic way that we would think that it's necessarily a lasting change. So we're monitoring this. We want to make sure that the cyclical stocks don't really start to soften up to where we think it's a growth scare. I wouldn't say that's there, but maybe they've been a little more hesitant going into Jackson Hole in this seasonal part of the year. Now, take a look at this other measure of defensive leadership. This is called the SHUT Index from Ned Davis Research. It stands for staples, healthcare, utilities, telecom, traditional defensives. And this is the current path of that index in orange here over the last few years, overlaid on the typical election cycle pattern for defensive stocks. So the magnitudes are different, the right-left scales are different, but it shows you that seasonally we maybe are due for a bout of outperformance by defensive stocks. That, of course, would coincide with the weak seasonal period overall for the market. So not surprising if we get a little bit more from defenses, but maybe not a trend change.
I mean, that's quite a chart right there. It's tracking almost exactly. And to your point, maybe a little more dramatic, but almost exactly.
Yeah, sometimes the cycle work does actually play out the way you think. But again, keep in mind, it's not predictive of magnitudes of moves from here.
Yeah, understood. And seasonality is at play. That's sort of my big takeaway from both of these charts from you.
It's still at play as much as you think it would be arbitraged away because everyone knows it's coming. Sometimes it also is effective.
Yeah. All right. Mike Santoli, great to get your thoughts, as always.
See you tomorrow.
All right, I'll see you tomorrow. All the major averages except for the Russell 2000 finishing lower today. It was the fifth straight day of losses for the S&P 500. It's the longest daily losing streak since January 2nd. The Nasdaq is actually on track right now for its worst week since May 23rd. And the Dow also finished lower today. We're going to keep an eye on Jackson Hole and that Fed Chair Powell speech tomorrow. But right now, that does it for us here at Overtime, and Fast Money begins right now.
Live from the NASDAQ market site in the heart of New York City's Times Square, this is Fast Money. Here's what's on the show tonight. We are right on the eve of Jackson Hole and hopes for a Fed rate cut at their meeting next month. Are they quickly fading? We'll talk about it all, what it means for you, your market, and your money. And also, what could we expect from Jay Powell's speech tomorrow? Will he hint to more rate cuts ahead or dash our dreams? Plus, Walmart woes. The retailer shares dropping after its first profit miss in more than 3 years. How tariffs might be the story, and how one former executive, by the way, sees things playing out. Plus, healthy gains for the pharma sector. How a logo change is sending shares of one restaurant company sharply lower. Can you guess who that is? And CME CEO Terry Duffy is here on his company's new partnership with FanDuel. They are bringing new prediction markets to their platforms. Hi, I'm Brian Sullivan, in for Melissa Lee, who is off again tonight. Coming to you live from Studio B at the NASDAQ. And on your desk tonight, Tim Seymour, Karen Feineman, Dan Nathan, and Guy Adami.
Welcome, Brian.
Thank you very much. We'll get to everybody in 1 minute. But we're going to start with this. The slow drip lower in stocks. The S&P notching its fifth straight losing day. Doesn't sound like much, but it's actually its longest losing streak since January 2nd. The benchmark index hitting a record just on Friday, but since it is down, not a lot, about 1.7%, but down 5 days in a row. The Dow and the NASDAQ also both lower today, and now also for the week, the NASDAQ negative for the month of August. Meantime, Treasury rates ticking a little bit higher. Yield on both the 2-year hitting its highest level since the start of the month. 10-year up a little bit as well. Investors focusing their attention on this year's big Fed confab in Jackson Hole, Wyoming. The market's going to be watching Jay Powell's speech tomorrow for any hint of what the central bank might do at its meeting next month. Odds of a rate cut coming down a little bit in recent days. They were basically 100%. now I think around the high 80s. Also on the radar, any new developments in the future of Fed Governor Lisa Cook. The Department of Justice today says is an investigation after the FHFA chair accused her of committing mortgage fraud. We'll get more on all of this from Steve Leishman. He is in Wyoming tonight. Steve, let's start with Jay Powell. That speech tomorrow, what do we know? What can we expect?
Yeah, you got it right there, Brian. Doubts are rising ahead of Fed Chair Powell's big speech here coming in Jackson Hole about just how dovish he's going to be. And I'm sorry to correct you, Brian, but you might have blinked, because futures markets now showing not 80, but a 70% chance of a rate cut in September and a 30% probability of no change. That's a high for this contract, and it's been happening throughout the day. The change follows some hawkish comments from Fed officials out here today. We had Jeff Smith, the Kansas City Fed president, telling us he remains concerned about inflation, and quote, "We really have to have very definitive data to be moving that policy right now." And then we had Beth Hammack, Cleveland Fed president, talking to Yahoo, said, "With the data I have right now, if the meeting was tomorrow, I would not see a case for reducing interest rates." Not good for that Fed probability of a cut. With two Fed governors, the president and markets pushing for rate cuts, Powell could finesse the problem by letting the data do the talking, allowing market expectations to adjust to two big data points, inflation and unemployment, that come in before the Fed September meeting. He could suggest tomorrow a cut is possible, but not necessarily promised, maintaining the 2% inflation target and the goal of hitting it is now near 3%, but say the Fed is still restrictive and would still be fighting inflation even after a 25 basis point cut. The likely result, no one ends up quite satisfied tomorrow with a speech that doesn't deliver as definitive a rate cut outlook as the Doves want, but will not firmly place the Fed chair among the hawks either. Brian?
Okay, so what happened, Steve? You are exactly right. I'm looking at some of the probabilities.
Don't blink.
I think I did blink because I swear this morning it was like 87% or last night.
You're correct.
Now it's 73%. So before we get to Lisa Cook, what happened?
Well, we did the interview with Schmidt. He was on the hawkish side. He'd been on the hawkish side. I think there's been some reporting that maybe said, you know what, folks, it may not be the dumbest idea to hedge a little bit your bet on that rate cut because, look, the Fed still has a 2% inflation target. And I don't know if you followed our Fed survey earlier this week, Brian, but the outlook for inflation this year is 3%. The outlook for next year is 2.8%. Really hard for a Fed chair to step up to the plate and say, I am cutting rates even while I'm not hitting my target and not expected to hit my target, even while the market's pricing it in. So the Fed chair has a really tough time to make it, to kind of finesse this issue. He's got a split on his committee, a really definitive split here out in public in terms of people saying they don't want to cut and those saying they do. And I could count, Brian, I think he has the votes right now for no rate cut if he wants it.
Wow. On a totally different note, obviously there's been a lot of drama around Lisa Cook, allegations, and there are only allegations of mortgage fraud. She basically denied it, saying that she's going to submit documents when she has to. Do we expect to hear anything about Lisa Cook at Jackson Hole tomorrow?
I mean, not necessarily on as part of the program. We'll have Beth Hammack on as well tomorrow after the Fed chair speech. We'll ask her about it. We'll have two former Fed presidents. We'll have Roger Ferguson, former Fed vice chair, and Patrick Harker on tomorrow morning on Squawk. We'll ask them about it. But mostly, look, they're saying, let's wait to see what Lisa Cook has to say. They see the attack as political, as part of this broad administration campaign to get them to cut rates. And look, the administration's playing for keeps. They're playing hardball. Whether or not they have the goods on Lisa Cook and whether or not there's an interesting thing that's been brought up today, which is, first of all, the Washington Attorney General told Powell he should remove Cook from her seat, but Powell doesn't have that authority. Only the president does. The president can only remove her for cause, but the question is, with these mortgages done before she was a Fed governor, does he have cause to remove her from what she has done as a Fed governor, which the mortgages were done beforehand? So, tricky situation. I think people are trying to say, let's take a breath here and let's see what Lisa Cook has to say and let the judicial process or the legal process work itself out.
But what you quickly, but what you said is very important, that Jerome Powell, even if he wanted to, and I'm not saying he does, it could have been anything, does not have the power to remove Lisa Cook or any Fed governor.
No, and Lisa Cook was rather defiant in her own statement, saying she won't be bullied out of office from a tweet. And she said she's going to take a look at the documents that, I guess, 5-year-old or 4-year-old documents that you hear about on air, Brian, whether or not you could reach those or find those right away to make sure that what Bill Pulte is saying is correct, and to see what happened back then. There might be a story, there might not be a story. She may have gotten this wrong. She may have messed up, may have done something illegal. And then I guess the chips will fall where they may. But let's all get the facts before we jump to conclusions, I'd say.
All right, well said. Steve Leishman, Jackson Hole, Wyoming. A huge, huge day tomorrow. We're really glad that you're there, Steve. Thank you very much. Guy Adami.
Yes, sir.
So it was, you hate being wrong sitting here, 87% chance last night, now down to 73%. Does the stock, not bond, does the stock market care about a rate cut?
I think so. There was this time last year when the S&P was about 1,000 points lower than we are now. The market was pricing in 6 rate cuts in 2025. Here we are now 1,000 points higher. We're talking about 2, maybe 3. So I would say all of that good news in terms of just rate cuts are priced in. So the short answer is absolutely. The market will be disappointed if they get anything less than.
I think the market really cares about a dovish Jerome Powell more than anything. I think even if they cut, don't cut, whatever, I think dovish Powell is very good for the market. I don't think that's what we'll get.
What's the Powell you think we have?
I think not dovish, closer to hawkish. I'm just saying, what would the market like? Dovish Powell, I think he'll be neutral.
Tim, what's the Powell we deserve?
Well,
the deserve ain't got nothing to do with it.
The Powell we deserve, but no, Dan may have been somewhat tongue-in-cheek, but the Powell we deserve is consistent with the Powell we've had. The Fed we've had so far should not be cutting in September based upon the heat of that PPI number. The 4-week job average on the jobless claims we just got this morning show that even during that payroll, even with some of the tick up during the August payrolls, that there's no material weakening in the labor market, okay? Inflation is better than where they have been, and this is a Fed that's been data dependent. So back to the Powell I want the Powell that's following the script that Powell has had. And I think what we have going into this is I think probabilities are higher based for the market on the cut based upon the politics. But that's okay. I mean, ultimately.
What politics?
Well, there's no disputing I won't get into the politics.
Let's
I'm
get
sorry
into the politics.
No, I don't want to use the P word. I'll talk about the fact that in the last month, since at least some of the heat has been more on the Fed, you've seen home builders rally 16%. You've seen retail rally almost 5%. You've seen interest rate sensitive parts of the market have an outsized move. There's no question the market has been moving on some sense that we are getting into a dovish environment.
Okay. So what I heard, the Fed minutes, Dan, we normally, we do them. I don't pay that much attention to them. Yesterday I did because the Fed minutes revealed they are worried about inflation. They're worried about tariffs. That would signal no rate cut. I mean, it could even signal a rate hike. But at the same time, they said they're worried about the job market and how AI is going to impact jobs. So if you're worried about jobs, that's a rate cut. If you're worried about inflation, that's not. How do they balance out?
Well, all this worry here. I mean, come on. I mean, they also said they're worried a little bit about asset prices. I don't know if you caught that one. I thought that was kind of interesting also. But, what
does that tell you?
We talk about all that worry, and I think what Tim's saying is the market's been climbing a little bit of wall worry. I know that's a line that Guy likes to use pretty often. If you look at the options market, it's pricing about a 3% move between now and the Fed meeting. So what do we have between now and the Fed meeting? We have tomorrow. We have the jobs report on September 5th. We have CPI. We have PPI, maybe the Fed's most favored inflation.
PCE.
Yeah, that's it. And that seems very complacent to me. So if you're looking at the markets right here and you want to get long, you want long exposure, it's 1.5% between now and September.
So what if we get a hawkish Jerome Powell, a defiant, maybe not political, but a defiant and hawkish Jerome Powell tomorrow?
I don't think he's going to be defiant. I mean, I think he's learned how to talk to the market. I think he's learned how to talk to the media. So defiant is not a word I would use, but I do think hawkish is an absolute possibility with everything that's going on. And, I'll say it again for the umpteenth time. They can do whatever they want tomorrow. I mean, take a look at what's going on in Europe, and we're going to talk about this a little bit more. Rates are going up across the world right now, except where in Switzerland, where they're collapsing. Why is that? Because their debt is about 37% of their GDP. So countries that are laden with debt are being punished in the form of their yields going higher. We are one of those countries.
All right, let's broaden out the conversation, talk a little more about what Jerome Powell's comments could mean for the markets, really the currency markets. Bring in Jens Nordvig. He is CEO and founder of Exante Data. Jens, good to have you on the program.
Thank you.
You know what else has happened?
No, what?
Besides your Swiss yields, the dollar has collapsed against the euro. It's been one of the most rapid moves of the U.S. dollar in months. What is that telling you?
So this year has been extraordinary. My company specializes in tracking capital flows, and that's where the big signals has been, like a big asset allocation shift.
From what to what?
Away from dollars in international portfolios. Like you can see how European equities have performed, right? Big outperformance. That's because people are allocating more to European equities. So we saw that very aggressively from March to June. And now it's less clear, right? So in the last 2 months, right, it's looking a bit more normal from a first half that was extremely unusual. And I think you're right to focus on the Fed now, because I think after this big sort of highly unusual asset allocation shift, we're going back to think about the Fed again. And the next leg for the dollar is going to be defined by what the Fed is doing. And we just talked about it. Is it unemployment they're looking at or inflation? Right. It's a very tricky balancing act here.
But Jens, so curious to hear more, though, about the fund flows and the asset allocation that you said was really more of a phenomenon maybe of 2Q, not necessarily 3Q. The dollar's been sideways since April. I mean, let's be clear. We got to $1.15 euro in April and back to the central bank differentials that you're saying will define the next move in the dollar. You know, at this point, I think it's somewhat unknown. My question really, though, is do you think that these fund flows to European equities and out of dollar-based products are coming from the rest of the world? Do you think this is U.S. investors that are overweight here thinking about the rest of the world more for the first time?
I think you can see some very clear patterns in the data, right? Europe was early in this because they also had the big German fiscal push in March, right? That got the euro moving. And then actually, if you look around the world, Asia kind of was a second chapter. They moved really later in the year, right? So June was when they really peaked out, right? So the euro hasn't moved that much since, early Q2, as you point out, right? The Asian currencies moved later. But overall, the dollar has now stabilized for the last 6 weeks. And we're looking at the data. Is the labor market going to force them to cut? I think it's down to that. The inflation picture is not clear.
But what do you think? Let's answer your own semi-question.
I think the inflation picture is highly problematic. Like, everybody looks at every single inflation report, right? And then after the last one, there was like sort of a lot of people wanted to run a victory lap saying, oh, we don't have that much inflation. But don't forget, tariffs actually came down a little bit after being super high in April, right? So when we look ahead, we're going to have another tariff shock where actually tariffs are going up again. So by October, that's when that is going to be really feeding in. So does the Fed want to be super aggressive? I think what is most likely is that they do, a pretty hawkish cut in September, a little bit of insurance cut, but they are not going to be committed to be on a multi-cut path because the inflation picture is just too tricky for them.
Let's go back to the dollar real quick, because this administration, the Treasury Secretary, is saying the quiet part out loud. They want the dollar to be weaker. Make no mistake about it. I mean, this is a policy thing. And be careful what you wish for. My question, though, at what point does it matter to the equity markets?
Yeah, so I've been connected with Scott Besson for many years. He was one of my first clients when I launched Exante Data, right? And he certainly has views on the dollar. But how does the U.S. really influence the dollar, right? The U.S. doesn't have reserves like China has reserves where they literally set where the dollar is. So it's kind of more down to verbal interventions, not that they can just say, okay, we want the dollar to go there, and when we spend $1 trillion to get it. So it's going to be more tactical, I think, how they impact the dollar with their verbal rhetoric. And eventually, it's going to be up to the cycle. Like, what is the cyclical state of the U.S. relative to the rest of the world? And it will be very odd if it's not the case that this big tariff push is going to be paid for mostly by consumers, and therefore consumption is going to shift down a gear when we look towards the end of this year.
Jens Nordvig, Exante Data, great stuff. Jens, appreciate you coming in.
Thank you very much.
Thank you very much. All right, we've got a lot more to do, and coming up, another retail giant reporting, and this time it is Walmart feeling the pressure. Not a terrible quarter, but the stock down about 5% today. Plus, today's fast movers include Paramount, Skydance, Cracker Barrel, and pharmaceutical names all catching our eyes. We're going to talk more about pops and drops and biscuits and gravy in 2 minutes.
The zoom in effect and
for certain.
All right, let's talk about Walmart. Retail Walmart stock tumbling almost 5% today, despite raising guidance for the year. The big box retailer did acknowledge tariff costs are starting to rise. By the way, first EPS miss, he said, in 3 years. I just threw them all in. One of them are going to be
One
right.
of them's right.
Let's bring in now former Walmart U.S. CEO Bill Simon for reaction. He's now on the board of Darden Restaurants. He is the chairman of Hanes Brands. Bill, glad to have you on. It was a miss, first miss in 3 years. You have the tariffs out there as well. And the weirdest thing about the quarter, and maybe you could address this, was these huge insurance costs for disability and other claims. How do we read the quarter?
It was about as good a quarter as any retailer could have in any environment, never mind.
Market didn't think so.
Environment. But look, if you liked them yesterday, I don't know why you don't love them today. Top line's growing. They're expanding their margin. Look, they felt good enough about their business to, buy back another $1.6 billion on top of the $4 billion they bought back last quarter. They are really hitting it on all cylinders. I don't get the decline in the market today at all.
How do we read the tariff issue, and how do we read this one-time insurance claim issue? I know it sounds a bit wonky, called WBI, wonky but important. We talked about it on Power Lunch today. It wasn't immaterial. It's a big deal for Walmart.
Everything at Walmart's a big number, and periodically they go through and reassess the insurance rates and the accruals that they have to make. And it sounds like it was one of those type of adjustments. It's a big number, but it's a one-time adjustment. It's not a systemic issue. It'll be adjusted, and they'll be reporting that. And the fact that they raised their guidance for the year, or actually they think they raised their guidance for the year, they're not concerned about it at all. As far as the tariffs go, there's no tariff impact in that business. Inflation is 1%. There's price increases, and there'll be item level price increases as items get tariffed. But, about 2/3 of what they sell is domestic anyway. A lot of it's food, and that's the high velocity stuff where the tariffs are going to bleed into the business. I think it gets absorbed either by the manufacturer. Walmart's clearly got room to absorb some. They were up 26 basis points in the U.S. in margin this quarter on top of 40 last quarter. So they've built some in for the year. They're not worried about it, or they wouldn't have held their guidance.
Bill, it's Karen. Thanks for being on. I agree with you. I thought the quarter was great. I thought the call was great. I'm long the stock. I think it was just expensive going in. But listening to the call, I thought that call was pretty bad for Target. It seems like they are the donor of market share, and I wondered what your take is on Target.
Well, Target's the reciprocal of Walmart. Walmart's got 70% of their product because of the real heavy food mix. 70% of their products are domestic and then not subjected to tariff. And if you look at Target's report, their margin was down 100 basis points where Walmart's was up. And so Target has the impact of tariffs on their business, and they don't have the food business and the velocity to be able to offset that. They got a pretty steep challenge ahead of them in this environment.
Bill, what did you make of the Target announcement, bringing an insider as the next CEO? I don't think that stock sold off on the back of the quarter as much as it sold off on the fact that you're just bringing somebody in internally to probably do exactly what's been done over the last few years. Thoughts on that?
Yeah, I think that's probably the fear. I don't know him well, but his reputation is quite a good operator. The fact that Brian's going to stay, I think he's staying as executive chair, or he's going to stay, keep his role on the board. I think people who don't love Target would probably not see a ton of change.
I'm vaccinated.
It's awful hard to change direction when you were probably the guy that helped get you down that road in the first place, and the architect of it's the chair of the company.
Bill, it's Tim. The gross margin was the one part of this Walmart number that I thought people at least were able to lean into. And I think it was going into the number part of a big focus because they were going to use kind of retail inventory accounting and blah, blah, blah. The whole story, though, for Walmart over the last 2 years or 3 years of re-rating has been about margin, has been about where tech and digital and DTC, well, e-commerce has been a big driver of margin. Just thoughts on this? And again, is this an opportunity? Because there's the gross margin profile and trend is quite good.
You can't really underestimate. I can't really even overstate. I don't even know the way to communicate it. The benefit to the P&L that sales volume, same store sales volume, delivers in operating margin leverage for Walmart. The fixed cost base that they have is enormous. But when you start jamming through 4 and 4.5% same store sales through that operating model, the supply chain efficiencies, the retail operating efficiencies just sheds money. If they could keep those top lines going, and that's their forecast, they're going to be just a bear of a company.
Bill Simon, always a pleasure to get your views. Bill, appreciate it. Thank you very much.
Thanks, guys.
Yeah, you're welcome. What he said, Karen, said a lot of interesting things. Number one, that so much of the stuff is groceries, that's untariffed. Not everything else, by the way, is tariffed. But you do wonder, if Target continues down this path, how much share gain, profit gain, is Walmart and Costco going to take?
Yeah, I would be concerned because Walmart talked about having that higher end consumer than they've traditionally had. So that's got to be someone who could have been at Target. And some of the mix of Walmart sales were in those areas that are some higher margin, not as much as we would like, of course, but still very good. And that's also where Target is losing out. I think it's donating share to Walmart.
It's interesting. Over the last few days, we had this volatility in the market led by some of the biggest stocks in the market, all AI related. And you saw a bit of rotation. You saw it into pharma stocks. You saw it into some staples. You saw it into energy and the like. And, I think that, Costco and Walmart are kind of staples right here, and they don't act particularly well. They never confirmed the S&P highs that we saw for the better part of the last month or so. So it's interesting to me that they weren't a beneficiary in the last few days, and they've been underperforming relative to the S&P over the last month or so. And you get a quarter like this, and you guys are all telling me it's great, and the guide's fine, and everything like that. But it's interesting that investors aren't willing to basically give them that sort of, appreciation right here.
Yeah, good stuff. Walmart, an interesting story. Target, maybe an even more interesting story. All right, speaking of interesting stories, there's a lot more fast money to come. Here's what's up next.
Paramount pops while Cracker Barrel heads south. The headlines behind both those opposing moves. Next. Plus, betting on the market. The CME teaming up with a sports betting giant to offer a new way of getting in on the market action. You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this. C+.
All right, welcome back to Fast Money. Got to switch it up a bit. Actually, talk a little bit about, Dami, baseball. That's right.
What we're talking about.
Because NBC Universal and Major League Baseball reportedly nearing a 3-year streaming rights deal that could hit $600 million. Julia Borston in the home of the Dodgers and sort of the Angels. What do we know?
Home of the Dodgers. Brian, we're Dodger fans in our household. Well, the MLB, NBC Universal, and Netflix all say no comment to the reports, but sources tell me that deals among those parties are coming. NBC Universal is in advanced talks to carry MLB games on NBC and Peacock, and a 3-year deal worth nearly $600 million, while Netflix is close to a deal to stream the Home Run Derby in a deal worth more than $105 million. This, according to a report in the Wall Street Journal. Now, while sources tell me the deal is not yet done, They also say that NBC Universal is close to securing a deal for baseball, including wildcard playoff games, and NBC could air Sunday games while other games stream on Peacock. And a source close to the situation tells my colleague Alex Sherman that the Netflix streaming deal for Home Run Derby would be between $35 and $50 million annually. Now, these deals would pay the MLB higher revenue than his previous deal with ESPN, though ESPN has reportedly made a deal to fold the MLB.TV streamer into ESPN's new Unlimited app, which just launched today. There could be some other deals for ESPN as well. And all of this could be a win for NBCU, giving it some more valuable sports content for Peacock. And for Netflix, this would build on its big move into live sports, which of course is valuable for its ad business. Brian?
Julia Borston in the home of the Dodgers. We got one. It's the LA Angels of Anaheim or whatever.
Well, I mean, first of all, the good news for baseball is after seemingly being an afterthought to some of the other sports deals that were getting done out there, they are going to exceed the $550 million a year. It must be, guys, something to do with the exciting baseball being played in Queens these days.
Yeah.
But ultimately, I think this is kind of interesting for the Netflix story. The Home Run Derby to me, as a baseball purist, I find it to be a little silly. Ultimately, though, it's an event. It's not necessarily sports. This is exactly where Netflix is going. I actually think it's a great thing for them because I think it's the kind of content that is very consistent with what they are doing in sports. I think the fact overall for Disney and the ESPN side of this is that ESPN right now, as we've kind of seen over multiple deals even that have taken place in the private equity side of both the media space and even how people are evaluating what DTC ESPN as its own bundle really means for Disney overall, I think it means that Disney is got an asset that is underpriced. I think this is all positive for ESPN and Netflix.
Very good. And a big interview, of course, on CNBC today with Bob Iger and Jimmy Pitaro, the head of ESPN. Go to CNBC.com to check it out. All right, coming up, kind of staying on sports, football season fast approaching. In fact, college football kicks off this weekend, but that is not the only action drawing the attention of sports bettors. The CME teaming up with FanDuel for a new way to play the markets. CEO Terry Duffy coming up. All right, welcome back. If you're just joining us again, here's how things wrapped up. Stocks closing lower, investors really waiting. I called it yesterday, guys, Jackson hold, because investors kind of waiting around to see.
I wasn't here yesterday, but that's clever. I'm glad I was here to hear you do it again today.
But somebody actually brought up the Bitcoin conference down the road and called it Jackson Hodl, which might even be better. So either way, the Dow dropping more than 150 points, the S&P falling 0.4%. By the way, the S&P 500 is now on a 5-day losing streak. The Nasdaq down about 0.3%. Let's get micro shares of Paramount Skydance. Jumping nearly 15%. Guys, Paramount Skydance is kind of like a meme stock at this point. It's up 45% since closing its merger. That move even comes as two top Democrats investigates whether the company's caved to demands from President Trump to win approval for the deal. Meantime, shares of Cracker Barrel dropping 7% today. The company facing backlash over its recent logo change. The restaurant chain removing. There's the old logo on the left. It's some guy.
What's wrong with that? Looks
and
great.
a barrel.
Is that Guy?
It's a guy, not Guy.
No, that might be Guy.
They stripped out the guy and the barrel, and they kind of freshened it up. They also changed in the stores.
That's disappointing.
What do we think? Do we have a ruling on this?
Maybe they feel a barrel like it's maybe like moonshine
over
or
a
something.
barrel. Have you ever been over a barrel?
I have from time to time.
Yeah.
Well, it is Cracker Barrel Old Country. I know you haven't been to one. I have been to many of them, and you go in and you shop and you buy licorice and stuff like that.
I've been to Cracker Barrel. Why do you think you're the only person that's been there? I mean, you know, we travel in the South as well here, and I love the South.
You've been to Maryland.
My wife's from the South. I've been to a lot of Cracker Barrels, and I'm disappointed by the logo change. I guess is what we're doing here. I don't like it.
So you're a Huddle House guy, not a Waffle House. That's the
Waffle House is the greatest place in the world.
Fair enough. All right, so we'll get more on that in just a bit here. Meantime, CME Group partnering with FanDuel to launch a new way of betting on financial markets for as little as $1 a contract. Customers in America will be able to place yes or no wagers on market-related events from specific price levels in the S&P to economic indicators like the inflation rate and GDP and more. Joining us now for an exclusive conversation on this is CME Group CEO and Chairman Terry Duffy. Terry, do not worry. I will not ask you about the Cracker Barrel logo change, but I will ask you about what some call the gamification of markets. Why this move? Why FanDuel? Why now?
Well, Sully, thanks for having me on. I appreciate it very much. Why this move? Why now? I mean, I think the world is evolving. You've seen CME move more into the retail trade over the last several years. I've said to many of times to some of the panelists on your show tonight that I think retail is going to continue to grow. And for us to have a partner like FanDuel and be able to have 14 million accounts on day one, to have the ability to participate in CME's markets at their comfort level is really important, not only, I think, to CME, but to the financial services industry as a whole. We want to have educated people in our marketplace. This is a great way for them to do it. We are going to offer these auction-style markets throughout the day, probably 3-4 a day in different asset classes. We have such massive benefits to do so with FanDuel because we have our intellectual property products that nobody else has. Then we also have the biggest, deepest pools of liquidity from our market makers to create this. So we think it's a great way to move forward with FanDuel. I want to thank my friend and partner, Peter Jackson and Amy Howe. They did an amazing job of seeing through how this potential JV is going to be something very exciting for them. It's not a cannibalization play. I'm not becoming a casino, contrary to popular opinion. I didn't buy a casino. These are markets that will be offered to the general public, and we think is massively exciting of what it could do.
So just to be clear then, Terry, and for the audience listening, saying what exactly is happening here, now we can bet on where certain things may come in. So if I want to bet that the unemployment rate is going to be 4.1%, I could bet on that, or do I bet it'll be above or below 4.1?
That's exactly what it is. It'll be set. And mostly, Brian, it will be on specific products that I outlined a moment ago, whether it's gold or anything else. So you'll set a price at a certain time, and then you'll have a window of opportunity to say, I believe it'll be above or below that, yes or no. You could bet as little as $1 or bet a lot more than that. And I say bet, you can trade to do that, and you get paid based on whether you're correct or not, where that price closed at that moment in time.
Hey, Terry, it's Dan. Thanks for being here. Quick one here.
Sure,
You
Dan.
just mentioned about retail, and this is obviously an extension of that. Going back to January, you launched futures on Robinhood. And so give us a sense of you guys have the biggest marketplace for futures in the world, right? And it's a very regulated environment with all the goofiness that goes on in the retail market. This seems like a great way to kind of get access to some of these bigger markets that institutions have had for decades.
Well, that's exactly right, Dan. I think it's really important. And I think we're at an inflection point also. I think that people want access to all different types of things, including financial services. And for those that are sitting on your desk and around that listen to your business shows, they should want that because that makes the ecosystem even bigger and level playing field for all. So that to me is a really good thing. But yet some of them can't afford to trade some of these larger contracts. So you bring them in at a level that they feel comfortable to participate in, and these will be fully funded. And I want to emphasize that, fully funded contracts. So you can only lose what you put into it or only make what you put into it. So there's no margin involved or anything else. So I think it's a great way to make certain that your customer bases continue to come forward for CME. This is a part of our strategy, Dan, with the retail. I have not lost my focus on the institutional part of our business. It's a huge part. I think that is going to continue to grow. But anybody who does not believe that other participants want access to markets and everything else, I think they're kidding themselves because they do. So we're going to offer it to all, and we're going to focus on all the different levels of participation in CME's markets.
I'm going to open up the kimono a bit and share with you that Brian showed us all a picture of Donald Sutherland and said that you look like him. Donald Sutherland, a very happy,
I never liked Sully. I never liked Sully.
But
He's shaking his head. I'm not sure he's happy.
I was going to say more a young Troy Donahue. That would be me. But I'll also say this in terms of predictive markets. People don't realize the FedWatch tool is the CME FedWatch tool. So you've been ahead of this for quite some time. So speak to that.
Well, and it's an important factor. You look at a day like today, guys, it's really interesting what's going on today. Our average daily volume in Fed Fund futures is around 440,000 contracts a day. Today, we traded over 650,000 contracts. And when you looked at the probability of the rate cuts this morning at 87% for September, going down to 70, you see how people need to manage that risk. So, sometimes it troubles me when people say, well, if interest rates go down, that means CME doesn't trade anymore. So if interest rates go from 4.25 to 4.5% to 3.75 or 3.50 or something like that, they can't go to zero anymore. We have $37 trillion of debt. There's so many different factors that are out there. People need to manage risk in interest rates. And it just goes to show you how sensitive it is when you have a contract like Fed Fund futures that goes from a probability of 87 to 70, and our volume almost doubles on an average daily basis. That's how important it is for the sensitivity of our interest rate complex.
And I got it wrong at the top of the show when I quoted 87% because it was that last night, Terry. Now it's 73.5%. Shows the liquidity, the velocity, and the volume of that contract.
You want to snap your fingers a few more times and annoy the remaining audience that we have?
I had too much caffeine prior to the show. Terry Duffy, new partnership with FanDuel. We love the predictive markets. Terry, love the beard too. Terry, thank you very much.
Thanks, buddy.
All right, take care. Coming up, pharma and healthcare names in the green today. Some of those stocks that are catching our attention and how these fine people around this desk.
Yes, thank you, Brad. Snap it up.
Snap it up. We're back right to
Peacock.
All right, weight loss drug makers Novo Nordisk and Eli Lilly getting a boost today after Serena Williams, tennis star, says she's used GLP-1 drugs to help her lose weight after giving birth. The tennis star partnering with Roe, which is funded by her husband's company. His name is Alexis Ohanian, and offers access to drugs like Novo's Wegovy and Lilly's Zepbound. Karen, your take on these names and maybe the partnership.
Well, I thought it was interesting. We know that she was related to Roe. We don't know which of the GLP-1s. And I remember Oprah not wanting to say which she was on because that would be a huge boost to whichever one it was. They were both up nicely, though. But I'm long both Novo and Lilly. Pharma's been tough, though, more generally, until recently.
All right. Long both Novo Nordisk and Eli Lilly. All right, coming up, coconut cold brew.
Ew.
Yeah, the changes
Sounds awful.
Starbucks is making to its drink menu and whether it can maybe recaffeinate.
Oh, boy.
That stock. Stick around.
Finding insurance.
We just had a 2-minute debate about the merits or the deficits of coconuts.
Oh,
Starbucks rolling out coconut beverages in hundreds of stores today, aiming to bring in a younger and apparently coconut-loving customer with its matcha and cold brew drinks. Starbucks shares down about 3% this year, but have come off their lows. New CEO, big change. Kate Rogers joining us now from San Francisco. Kate, is coconut the thing now? Is the beverage the moment?
It is the beverage that is the moment. Good recall to my story from a few days ago, Brian. So the drinks are called Cocoa Matcha and Cocoa Cold Brew, and they layer matcha foam or cold brew foam over coconut water. This is a test expanding to 400 additional cities today, including New York, Los Angeles, and the greater Chicago area, as it leans further into health and wellness. The company's senior vice president of global product, Dana Pelicano, told us, quote, health and wellness at Starbucks isn't a trend. It's a longstanding commitment.
expanding the test of our cocoa matcha and cocoa cold brew beverages is the next step to accelerate our health and wellness beverage innovation plan. Cold beverages, energy drinks, and healthier options are all of high interest, of course, to a key demo, Gen Z. Starbucks CEO Brian Niccol told analysts in the most recent quarter that Starbucks customer value perceptions were near 2-year highs, driven by gains among Gen Z and millennials. They now make up over half of Starbucks customer base. This also builds on the cold foam platform, which has become one of the company's most popular drink modifiers. In late Q4, Niccol also said that they will launch protein cold foam, which is another health and wellness offering. So again, all of these drinks, cold drinks, energy drinks, and healthier drinks, very, very popular with younger consumers, which are so key in this environment, guys.
I guess coconut is the moment. Kate Rogers, thank you very much.
Thank you.
Mr. Coconut.
Yes.
You love coconuts.
Do love who
Is this
doesn't?
going to bring you
Who
back
doesn't?
bring you into Starbucks more?
I hadn't thought that coconut was missing from my coffee drinks or my underneath my matcha water or whatever was going on there. I just wish Starbucks would brew coffee and rather than use those crazy machines. But I like the story of Starbucks. I like what they're doing on the operational side. I think the story for Starbucks is as much, though, about where discretionary spend might run out of some gas. It's not terribly expensive, but it's not shockingly cheap. I think this stock is range bound as much as I love the stock and as much as I love the place.
I think it is a little expensive. What I will say for me would be cocoa matcha. I need the code to the men's room in like 30 seconds if I were to have one of those things.
So you're not a matcha
My
man.
constitution.
Okay.
What did you just say?
See that? Oh, boom.
Yeah.
Up next,
Sort of.
your final trades, we hope.
Matcha man.
Tim, final trade time.
Brian, I'd like to snap my fingers, but instead I'm just going to say Target is my final trade.
Karen.
Yeah, Cracker Barrel's intriguing. If they were to reverse course and say, well, you know what, made a mistake, we're going back to Hilton, I think it goes higher than where it was yesterday.
If they reverse, Dan?
K-Web, that's the ambassador's way to play Chinese internet, playing for a breakout.
Nobody likes coconut. Mounds don't like coconut.
Love Mounds.
I'm enjoying. It's not good.
No, it's really good.
No,
and then there's the Bounty
Starbucks,
Bar.
if that Starbucks going to turn the corner, then
pick is
Walmart.
Thank you. Folks, thanks for watching Fast Money. I hope to see you tomorrow night. We'll see. Mad Money starts now.